Apple's earnings crushed market expectations, yet its stock dropped 4%. What are institutions quietly doing? Apple has just released its latest quarterly earnings report in after-hours trading. Following the release, the stock plunged by roughly 4%. Many people must be confused by this. What exactly has gone wrong with Apple? What key details in this earnings report should we focus on today? I'll explain all these questions clearly in one go. We won't just look at surface numbers. We'll also understand the real mindset of market capital first. Let's quickly go over the core results. This quarter, Apple's revenue and profit both beat market forecasts. Earnings per share came in nearly 20 cents higher than analysts' estimates. Total revenue rose by around 12% year over year. It was nearly $5 billion higher than what the market had expected. Put simply, Apple has significantly outperformed expectations for several consecutive quarters. It has repeatedly wrong-footed investors who bet against the company. Despite such a strong earnings performance, the stock fell in after-hours trading. Many retail investors can't figure out why. In fact, this is a common emotional trade in the market known as good news, turning bad once priced in. It has little to do with the company's underlying fundamentals. Next, look at the actual operating data and see how resilient Apple really is. Apple generated roughly $95 billion in revenue. This quarter, its revenue in the previous quarter was $93 billion. The quarter-on-quarter growth trend is very clear. The year-on-year growth rate has also stayed steady and solid for a company of Apple's enormous size to still achieve double-digit growth. Few tech giants worldwide can pull this off. Apple's gross profit margin averages around 38% over the past decade. This figure has remained highly stable and has been rising slightly over time, even amid supply chain disruptions, currency fluctuations, and rising R&D expenses. Apple's gross margin has stayed within a consistent range. This is the powerful competitive barrier built into its business model. Apple's return on invested capital has stayed above 25% for a long time. Its profit-generating efficiency is extremely high. This means every dollar Apple invests delivers consistent high returns. This is also the core reason investors feel confident holding Apple stock for the long term. Apple posted roughly $82 billion in free cash flow this quarter. That is slightly lower than the previous quarter. The reason is actually simple. The company's capital expenditures have increased. All this money is being invested in long-term growth, not a sign of operational trouble. Now, let's look at Apple's three core businesses and see which ones are driving the company. Apple's main operations are divided into three segments. They are iPhone, services, and wearables and other products. iPhone revenue rose by approximately 10% year over year. It is Apple's undisputed cash cow and its most important revenue source. The iPhone has almost no competition in the premium smartphone market, although users are keeping their phones for longer before upgrading. Its user retention rate and brand pricing power still rank first in the industry. Services revenue grew 18% year over year. It delivers stable growth and high gross margins, making it a reliable pillar for the future. This business is asset-light, has high user stickiness, and supports recurring revenue. It is also key to Apple's transformation from a hardware maker to a tech ecosystem giant. Revenue from wearables and other products fell slightly by about 2%. The decline is small and has minimal impact on overall performance. The entire category is still in an expansion phase. Short-term minor fluctuations are completely acceptable. Apple's overall revenue rose 12% year over year. On a constant currency basis, the growth rate was roughly 11%. Gross profit margin edged slightly lower. This was mainly due to increased spending on new product development and supply chains. It is a healthy short-term adjustment, not a sign of deteriorating operations. I want to emphasize an important point here. A short-term drop in free cash flow does not mean the company is less profitable. Free cash flow is the money a company can use at its own discretion. It can be used for reinvestment, debt repayment, acquisitions, share buybacks, and dividends. Higher capital spending naturally leads to a temporary reduction in free cash flow. Every investment is laying the groundwork for future growth. Apple's latest round of increased spending focuses on several areas. These include new factory construction, in-house chip development, and retail store infrastructure upgrades. Every major capital expenditure by Apple will yield clear returns within 1 to 3 years. This is also a major reason institutional investors dare to hold heavy long-term positions in Apple. Should we panic just because the stock fell 4%? Short-term market volatility and stock price declines have no fundamental connection to the company's long-term value. For long-term investors, this round of stock price drops is actually a great opportunity to add to their positions. Many institutional funds had already pushed up the stock price ahead of the earnings release. Once the positive results were official, short-term capital took profits and exited. That is what caused the after-hours decline. Apple currently has a highly diversified business structure. Every small increase in the share of these businesses makes Apple more resilient to risks overall. Wearables include the Apple Watch and AirPods. They still have enormous growth potential ahead, especially with continuous upgrades to health features. Apple is moving into the trillion-dollar health technology sector. Apple invests huge sums in research and development every year to maintain product innovation and long-term competitiveness. This is especially true in artificial intelligence, although Apple does not promote itself as loudly as NVIDIA or Microsoft. It is quietly increasing investment in underlying computing power, on-device, AI, and system-level integration. Once these technologies launch, they will further strengthen the company's competitive moat. Let me also clarify 2 concepts for you. Growth capital expenditure is used for business expansion and technological innovation. It will drive higher profits and cash flow in the future. Maintenance capital expenditure only keeps existing operations running. It rarely boosts future profitability significantly. Most of Apple's current investments fall into the growth category. The company focuses heavily on R&D and infrastructure, targeting AI, cloud services, and next-generation hardware innovation. Is Apple overvalued right now? Is it still a good buy? Tech stocks overall are not particularly cheap, but Apple's valuation aligns with real market demand. Over the long term, Apple is a classic compound growth asset. Its cash flow builds steadily, dividends rise consistently, and share buybacks continue. A short-term stock pullback is actually a gift for patient investors. Let me explain the valuation logic in the simplest way. It is the present value of all future cash flows discounted to today plus the company's cash on hand minus total liabilities divided by the total number of outstanding shares that gives a stock's intrinsic value based on comprehensive calculations. Apple's intrinsic value is around $205 per share. With the current price at $195, there is roughly a 5% margin of safety for a giant like Apple with extremely high predictability. A 5% safety margin combined with ongoing buybacks and earnings growth makes the long-term investment win rate very high. Let me end with some straightforward advice. Short-term market ups and downs are essentially potential investment opportunities. Don't fixate on daily, weekly, or quarterly price swings. Focus on the industry and company trends over the next 3 to 5 years. In the coming years, Apple's revenue and cash flow will continue to grow. They will fully support the stock in returning to a reasonable level and moving higher. Holding high-quality companies like Apple for the long term can deliver stable compound returns as long as you stay patient. Feel free to share your thoughts in the comments section. What do you think of Apple's latest earnings report? Do you plan to buy more, hold, or reduce your position? One thing I need to clarify in advance. I am not a professional financial advisor. This video is for educational and informational purposes only. Please make sure to do your own research and due diligence. My view is very clear. A stock price drop is an excellent time to build long-term positions. Don't be scared away by short-term declines. Pullbacks in high-quality assets always reward investors who truly understand the market.